I get this question every single day. Michael, is now the right time to sell my business? Should I sell my business? Always a question. And what I tell people is there's no perfect time to sell a business, ever. But there are two times when you should sell a business. One, when you're absolutely unhappy, or two, when you absolutely have to sell it. Then there's no question. Over 30 years, I've been involved in over $2 billion worth of transactions as a buyer, seller, and advisor. And I've learned a few things along the way, sometimes from painful lessons. I've learned that people will sell too early out of fear, and sometimes they'll hold on too late out of greed. Both will cost you millions of dollars as well as emotional distress. In the next 12 minutes, I'm going to give you the exact framework I use to exit and have sold millions of dollars worth of companies and still hold millions of dollars worth of companies. And this is what's helped me determine when it's the right time to sell or not. So let's get started. So let's go through the most common reasons to sell your company. One, retirement. You want to get onto something new. That's natural. Every age of retirement's different for people. Sometimes people want to get out 55, sometimes 60, 65, even 70, 75. This is an individual decision. It'll be reflective of your business and you, your family, and everything else, but that's only you can determine what that right time is. If you're burned out, that's another time you want to sell. Why? Because if you're burned out, it's going to show up in the business. If it shows up in the business, the value is going to go down. You're much better to get the business listed, get it sold, and get on to something else to get you energized and excited. Because your passion is what's driving the business now, and if you lose it, it's going to show up in the business. New opportunities are another reason. If you think you've got the ability to go do something different that's going to make you or your family more money, or if it's just simply something you want to go off and do, don't do it if it's going to impact your business. Sell your business first. Make sure you've got the capital in the bank. You're freed up from that obligation, and you're able to dedicate all your energy and money and time into whatever your new venture is. The other big category is life events. That means death, divorce, taxes, financial hardships. All these things come into play to oftentimes say you have to sell, there's no choice. And sometimes you have to sell pretty quickly. So getting ready to sell, making sure that you've got the right advisors, that you've got the right systems, getting the right price, going through the process, it takes time. And if you don't get started now, you may be up against a clock that you don't want to know about because it's going to hit you in the checkbook by losing millions of dollars because you should have started sooner. So let me sum up this whole concept of why would you sell now or why would you not sell now. It comes down to you doing a true self-assessment of what your motivations are, along with the state of the business, your view of the economy. Everything gets put into that, and only you can determine when the right time is. However, I'm going to go through the rest of the process that you need to go through to be objective about it, even writing it down so that you can look back later and say, did I make the right decision? Did I do the process correctly? This is going to help you come to that point. The personal reason about why you're going to sell a business is you. You're the one that's going to make that decision. You may have advisors, friends, and people you count on, but it's always about your self-assessment and the why behind what you want to do something. Understanding the why is really critical. So let's start off with, is your business actually sellable today? That's a key determination of whether you sell today or you sell in the future as well. Have you figured out the why you want to sell your business, or should you sell your business now? Now we have to figure out and determine, is the business in a position to be sold? So there's a few things that we're going to go through, and I'll jump into each one with a little bit more detail to show you why you have to pay attention to each of these to maximize your value. One, do you have your books and your financial records in order? Have you talked to your accountants? Are your tax returns caught up? Are the books reconciled? Have you taken the personal add backs and the things that are going to help determine the value to a buyer, and have you documented that? The trip that you took to Hawaii with the family is probably not a business expense. And if you record it and don't add it back, that's going to impact how much someone's going to come in and pay for your business. You don't want to run all your personal expenses through just to save taxes if you're going to lose out when you go to sell the company. This is your business. It's time to maximize your profits. Do you have a management team that can take over for you? Some businesses are smaller and you are the owner operator and you have to make everything work. You can't step away from the business. Those businesses can sell, but only to somebody who wants to buy that and put themselves in the same position. Most times you're going to get more value out of putting management in place, even if it's a supervisor management person's been with you a long time. Give them the responsibility, prove that they can do the job. Can you go away on the vacation test of 2 weeks and not have to deal with anything and come back and have the business in good shape? If you can do that and demonstrate that to a buyer, you're going to get a higher price, a quicker sale, and an easier transition, because you've done the work up front and you put the right people in the right place. Do you have SOPs, standard operating procedures? That can be everything from how you do your accounting, how you order your inventory, how you deal with customers. The more you document, the more you put everything in a system that you can show to a new buyer that you've done that. It's worth hundreds of thousands of dollars, if not millions, to a buyer to get comfortable that they've got systems they can step into. You can teach them that, and they'll pay you more for the work you're doing now to have that in place. If you've got recurring revenue or transactional revenue, and it's the subject of another series that I'll get into in the future, but recurring revenue gets a higher multiple. What's recurring revenue? Subscription, software, data, things that you can charge for on a monthly basis under contracts where customers are going to stay with you. That's what we call recurring revenue. You want to highlight that. You want to have that separately listed on your profit and loss statement and be able to show the buyer that you're increasing your amount of recurring revenue as you're growing your business. Transactional revenue, which is one-off transactions. This would be typically projects if you're in construction, if you're doing plumbing, you're fixing a problem and going back. These are all transactional businesses, and they have non-recurring revenue. That's okay, it gets a lower multiple, but what you want to show there is that the customer base continues to buy from you. It might be a different project, but you know every year they're going to come back and they're going to buy and fulfill their needs because you've done a good job for a long period of time. Working on the customer base, making sure you're splitting out the recurring revenue from the non-recurring revenue and showing that you've got a plan for both of those is going to get you your highest price. Now, next is the timing of this. Is your business seasonal? Is it not seasonal? Do you have the energy and time dedicated to meeting with buyers and going through this and keeping the business on track at the same time? That's also getting back to an earlier point why you want to have somebody who's running as much of the day-to-day as you can get. If you've got the right time to sell the business and it's not seasonal and this is a good time to do it, then you need to understand it's going to take 2 or 3 months of your time to get it under contract, and you've got to be able to put that time aside, work with your advisor, your broker on the deal, your lawyers, your CPAs, anybody else who's on your advisory team, and make sure you can dedicate the time and energy to this, because it's very important to get this done smoothly and efficiently to get your thing. You don't want to fall out 2 or 3 times with different buyers along the way. It's really important to do all the work up front and be in a position to have a smooth transaction. Next, are you emotionally ready? We talked about the business. Is it ready for sale? How about you? And you means you, your family, and anybody who's close to you. Have you thought about what's going to go into this process? What it's going to be like to take a business you either started or acquired or been with for some period of time? Have you gone through the visualization exercises to say, what is it going to be like after I sell? What's it going to be like if I don't have this business to have to go to every day? And if you've gone through that analysis and you understand where your dreams and goals and aspirations are lined up with selling the business, then you're in a good position to have a good positive outcome emotionally. Because if you make a lot of money and you're unhappy when you sell it, because you missed the business or you need something else to do, it's best to figure that out now. That's part of the tools in the self-assessment to go into what's your emotional side of this, and do you feel like this is something you really want to do, and you know what you're going to do with the money, what your family's going to do, how you're going to relate to each other. It's all part of it. You're going to have fears, you're going to have doubts, you're going to have things that you need to talk to somebody about. Do you have a board of advisors you can lean on? Do you need to talk to your advisors about this? Are there books you can read, podcasts you listen to, YouTube content? All these things are out there to help you get through this process in a positive emotional state. And that's what you want to do. If you keep your expectations in line, if you say to yourself, I know this is going to take time, I know there's going to be some bumps in the road, but I know this is going to be worth it when I'm getting done because it's fulfilling the goals I set out to achieve, then you're going to have a much better experience and a much better outcome than somebody who's unprepared. Let's talk a little bit about what's your life going to look like after the sale. That's something that I encourage people to go through and actually write down. What are the things you want to do with your time and your money after you sold the company? Because most likely the transition to selling is fairly short. People think they're going to stay on for years. It's less than 10% of the people that stay on for even 6 months. And that's between the buyers and the sellers. It's really hard to adjust as an owner to working for somebody else after. Even if you decide to put some capital back in the business, it's their business now. You're used to being in the front of the car, driving the car. Now you're in the back seat, maybe even the third row. It's really important that you go through and figure out what you want to do in that dream board. When you've sold it, now what am I going to do? Start a business, buy something else, retire, travel, teach, get your golf score in line, whatever it is. You just need to write that down. And I encourage everybody when we start this process to go and create and cut out and find pictures of the things that represent what they want to do, so they have a very strong visual clue about why they're doing this in the first place. Next, I want to go through and discuss, how do you value the business? What's it worth? And it's what's it worth not to you, it's what's it worth to a buyer or a series of buyers, so that hopefully there's some competition that they all express an interest and help drive the price up and make it a smoother and a higher transaction for you. Basically, the way our business field divides everything up is what we'll call Main Street or lower middle market businesses are under 2.5 million of earnings. Earnings are generally construed as cash flow or seller's discretionary earnings or adjusted EBITDA. That's a fancy way of saying it's basically cash flow. EBITDA is earnings before interest, taxes, depreciation, amortization. You cut all that out and you add it all back. That's what they do in the bigger deals. If your business is earning less than 2.5 million, it's most likely going to get valued on seller discretionary earnings, which is your cash flow, assuming you added back all the personal expenses and your compensation that you're taking out, because you could take out as much as you wanted. You could take out 100% of earnings of the company. You can take out more than 100%. We always add that back. And that's part of determining the earnings, seller discretionary earnings, or SDE for short. That's going to be the basic and the multiple that goes with the industry. For example, certain businesses with recurring revenue and a more stable customer base that aren't transactional in nature, been around a long time, will oftentimes get a slightly higher or even much higher multiple on seller discretionary earnings. If you have a business, you just started it up, it's been up and down, that multiple will change. Why does that mean something? If you have a business earning $1 million and it trades at 4 times seller's discretionary earning, SDE, that's a $4 million purchase price. However, if you got the business ready for sale, it's the right kind of business, people have it, you have a couple buyers, maybe it trades at 5 times. 5 times that is a $5 million deal. That's $1 million difference in price. All because you position the business properly, and that's how it gets valued. It's all those little things that go into it. Your business advisor and broker and lawyers will all work towards getting you in a position to maximize the multiple on the earnings that you can present. The multiplier effect means that for every dollar of earnings that you can put back in the business or grow the business while you're doing this, you're going to get 3, 4, 5 or more times in the price. Add $100,000 of earnings, get 4 or 5 or 600,000 more purchase price. Everything you do around the seller's discretionary earnings increases or decreases the purchase price because of the multiplier effect. That multiple is one of the big determinants, along with your earnings, on what this is worth. So getting it positioned properly and getting the right multiple and trying to maximize it is really important too. Okay, next I want to talk about the process. So you've decided to sell. You think, hey, it's called a BOV, broker opinion of value. That's an estimate from an experienced business broker and advisor about what the business will likely trade for based on other comps in the marketplace, comparables. What do? First, you're going to use an advisor or a broker to help you sell the business. The vast majority of people that try to do it on their own never get a business sold. It's not well represented. It's not positioned properly. They're not serious about it. If you're serious about selling, you need to hire somebody. They will get enough value created to justify whatever fee is being charged in the transaction. That's their job, to go out and get you multiple bids. So first, you got to select an advisor. Talk to 2 or 3 if you want. Look at your reputation, reviews, see if somebody in your industry that you know sold the business and who they used. Those are all good tools to use. But selecting the right advisor is really, really important. Second, do you have a good attorney that understands M&A transactions and how you're structured and what you're doing. If your attorney is a real estate attorney, for example, and doesn't know this, ask him for a referral for somebody who could work with him and you to get this done. Tax accounting, CPA, also important. Make sure you let them know what you're doing, get some advice. Sometimes there's some pre-sale tax planning. It might involve moving the real estate out into another entity prior to the sale. With good counsel, you can go through and save a lot of money by getting the business positioned properly before you go to sell it. Now, you got to sign a listing agreement. You're ready to go. What does that mean? Once you sign the listing agreement with your broker or advisor, the next thing is generally around 30 days of work where they're going to take all your bank statements, accounting records, inventory, put it all together, reconcile it, get it all put together in a book that's going to be anywhere from 10 to 30 pages of material that's going to go out to prospective buyers that all sign an NDA, non-disclosure agreement, which means that all your information is protected. If you're sensitive about having the name out at all, I recommend taking the name out of it in the book and using a target name. Oftentimes we just make up different names that kind of fun. Could be your favorite color or sports team or whatever it is. And that just becomes the name that we go to the marketplace of until it gets to a contract. But we always make sure that advisors get an NDA prior to showing any of the information to anyone else. The process itself, once the NDAs are signed, the broker and advisor are going into conversations with them, keeping you pretty much out of it. You aren't going to have to talk to any of the buyers unless you want to until it gets narrowed down to the 2, 3, 4, or 5 that are the most serious, that are in the right price range, and then it's time to meet them. You get to be involved in the selection of who those people are based on their strength, their reputation, the way they're talking about it, their proof of funds. The broker's doing all that for you, but you're the ultimate decision maker. Now you decide I want to go with, let's say, 2 potential buyers. Of those 2 potential buyers, they're probably going to come tour the facility. They're probably going to meet with you. You're going to see how comfortable you are. You're going to do some reference checking on your own. And then there's going to be some back and forth. They're going to have questions in due diligence. The broker is going to handle that for you. They might need some additional accounting or other information from time to time. 90% of the transaction revolves around the communication between the broker and the buyer. You're going to be involved in any decision process about any agreement to sell and what the consideration is between cash, seller notes, or whatever it may be on the structuring side of it. Basically, you've got your team, you want to get started, you've got buyers. Now a buyer comes in and says, okay, we've agreed on a price. That's called a letter of intent. From that letter of intent, the process really goes into it. You now have one buyer and you're all going towards the finish line. The next part is they start their due diligence, which is a lot of detailed questions. They don't have to meet with management. I generally recommend that you don't allow them to meet with people on your team unless it's your financial person. That's generally the one exception. So we keep this very quiet. Customers don't know, vendors don't know, employees don't know, unless you want to bring them in on the process. That next step is you're going to get a contract. Buyer says, okay, the deal's good. I'm happy. We're going to have a contract. And there's 2 types of contracts. There's what we call sign and close, or a contract with a future sale date. Contract with a future sale date, it's just what it sounds like. You sign a contract and you agree to close by a certain time, generally 1 to 3 months. We try to keep it to 1 to 2 months. The outside, you don't want this to drag on too far. A sign and close means, and these are done commonly in public companies and bigger deals and things where no one's legally committed to sell until you actually sign. And when you sign, you close and the money changes hands then and there. So there's 2 different ways to generally go after that. Majority of the transactions in this size are going to be contracts that are signed with a certain period of time to close. All that's possible and subject to your, as an owner, your decision on what you want to do. Let's talk about the closing. What's the closing like? The closing's pretty simple. They're going to wire the money into an escrow account that's either done through the law firms or an independent third party like a title company. And the bill of sale changes hands and the deal is closed. Typically it gets closed at the end of a week. A lot of reasons for that. But then the next part of it is after the close, you have an employee announcement and you start telling everybody about it. They come on site, you do a joint presentation, you put a positive spin on it, and then typically for the next 30 days, you're pretty busy fielding phone calls and getting things done. That's the general process, start to finish. I think it's going to take 6 months on average. It can go as long as 9. 85% of the deals we're involved in always sell. There are some situations, business goes down, market conditions change, things can happen. But if you're well represented and you put the company in a position to sell, it will sell, but it won't sell that quickly. It will take best case 3 months, average 6 months, worst case 9 months. That's the way to plan for it. So now that we've gone through all that, is it the right time to sell your business or not? Is your business ready to sell or not? And then the last thing is, are you ready to sell the business? The perfect alignment of all three things is just not likely to happen. It's a process that you have to decide to do, and whether you sell the business immediately, in the short term, or somewhere down the road, almost all businesses sell. They either get closed down or they sell. That's why getting it started now is generally a good idea. Getting ready to sell, you can always defer some of that, but getting ready today, getting started is really, really critical for you to achieve the kind of money and successful outcome that you've worked so hard to get. If you have questions, feel free to reach out to me. You know how to get a hold of me, LinkedIn, YouTube, wherever you want. And in the meantime, there's plenty of good information out there on podcasts and other things. I hope you find some of it, and best of luck to you.